Energy Regulator is to work for Australia's future productivity and living standards by contributing to a decarbonising, affordable and reliable energy system for all consumers. Currently, the regulator is examining the rate of return given to investors, and they propose to increase the rate of return from 5.78% to 6.86%. This is an 18.68% increase, which will translate into probably about a 15% increase in the price of electricity. Maybe a bit less, maybe a bit more. This is not affordable for many consumers. This is not in the interests of consumers. The reason for the regulator's increase is to attract new investment from overseas and from local institutional investors, not from everyday investors. There is an alternative that we can adopt, and that is to attract consumer investment. Let's have a look at these investments. In regulated industries, investors receive a fixed returns on a regulated asset base. This is a fantastic investment, and anyone would, maybe not anyone, but most people, most investors, most consumers would love to have, if they've got some money to invest, would love to have an investment in such an industry. It's a guaranteed return on investment. It's just excellent. But how can we do it? Because at the moment, capital is in the form of equity and or loans. And it only goes to existing investors. And the existing investors are private investors, private equity investors, almost overwhelmingly. They're private equity investors or government and overseas government wealth funds seem to dominate the ownership of regulated investments. Consumers simply cannot invest. There is no way for consumers to invest at the moment. So let's find a way to do that. And we can do it with consumer capital alternative. Now, consumer capital alternative is effectively an annuity in electricity. So a consumer can prepay for their electricity, and the return of the return on the annuity is given in lower priced electricity. So you pay up front, and then you could buy 20 years worth of electricity for, say, 10 years amount. That's a way in which consumers can invest. Importantly, when the annuity is repaid, so as the annuity or the prepayments, there is a capital component. And the capital component is paid for, but the capital still exists. So what happens to that extra capital? The investor, the original investor, has still got it there because they've still got a little bit of it there anyway. But the other capital, what are we going to do with it? Well, what we do with it is that we give it to any consumer who purchases electricity capital released from the annuity payment. That transfers to the consumers. That money must be invested in more, it's reinvested effectively. So the capital is transfers to the consumer, and the system reinvests that capital. So now we have the original capital plus this reinvested capital, this extra capital that's reinvested. So the proposal is to introduce competition into the capital market for regulated industries through the idea of consumer capital. So we bring competition into the marketplace. And the consumer capital competition is that it'll be indexed annuity with a 5% return. Not a 6.86% return, but a 5% return. We can see whether international capital is interested in a 5% return, or we can just use the consumer capital. See how we go. But how can you start? This is a pretty radical idea. It turns out not to be too hard to implement, but there will be some interesting quirks, I'm sure. So let's use it first to fund community batteries and other storage. Let's start with community batteries. The advantages of doing this is that all consumers and investors will benefit, and not just investors, and not just overseas investors. It entitles consumers to a voice in governance. So people who hold consumer capital, they should have representation on the board of the regulated entities. So if it's funded if a battery is funded solely with consumer capital, then the consumers will have full voice on governing the batteries. And it turns out, of course, is that there will be lower cost of storage. We know that consumer capital is viable at the moment at about $800 per kilowatt hour. We also know that company financed batteries, if we go the equity or loan route, is going to require subsidies. It's the same batteries, but one requires subsidies and one doesn't. What's going on? Well, prepayments are simply a more efficient form of capital. And when I say more efficient, I mean it costs less to transfer the capital from one party to another, and the capital moves more quickly. And that means that we get more investment for the same amount of capital. In fact, we get double the amount of investment from the same amount of capital over a period of years. Not immediately, but over a period of years, the investment doubles from the same amount of capital. So the proposal is to regulate community batteries, allow the regulations to encourage, if you like, community batteries to use consumer capital at a 5% rate of return. What the regulator decides to do with the other capital in the system, the existing capital, is up to the regulator. But let's just try this out and see what happens. More information from Kevin Cox, kevin@wlpc.com.au.